Welcome to EnrichMinds.com and our session on credit scores. We all got graded in school, college, and university to tell us how we were doing in our studies. Our doctors check our blood pressure and other vitals to tell us about our health. Similar is the case with our financial health. We shall learn about credit scores and ways to improve our financial health in this session. Credit score is just like the grades we get in school. Someone with an A+ is considered to be a good and hardworking student. Just like that, a person with good credit score is considered more reliable and trustworthy. Those with higher credit scores get loans easily as they are seen as trustworthy. A credit score is based on how you've paid the loan and credit card dues in the past. There are many different companies that calculate your credit score. Some offer a score between 300 and 850, while some use the range 300 to 900. But they all mean the same thing. The higher the credit score, the better your overall financial health. So, a credit score is a numerical expression based on a level analysis of a person's credit files to represent the creditworthiness of an individual. A credit score is primarily based on a credit report, information typically sourced from credit bureaus. There are three major credit reporting agencies in the United States: Experian, Equifax, and TransUnion, which report, update, and store consumers' credit histories. While there can be differences in the information collected by the three credit bureaus, there are 5 main factors evaluated when calculating a credit score. First, payment history. Second, total amount owed. Third, length of credit history. Fourth, types of credit. Fifth, new or recent credit. We shall look into each one in some detail. So, how is credit score even calculated? Payment history accounts for 35% of a credit score and shows whether a person pays their obligations on time. Total amount owed counts for 30% and takes into account the percentage of credit available to a person that is currently being used, which is known as credit utilization. Length of credit history counts for 15%, with longer credit histories being considered less risky as there is more data to determine payment history. The type of credit used counts for 10% of a credit score and shows if a person has a mix of installment credit, such as car loans or mortgage loans, and revolving credit, such as credit cards. New credit also counts for 10%, and it factors in how many new accounts a person has, how many new accounts they have applied for recently, which results in credit inquiries, and when the most recent account was opened. A credit score can significantly affect your financial life. It plays a key role in a lender's decision to offer you credit. People with credit scores below 640, for example, are generally considered to be subprime borrowers. Lending institutions often charge interest on subprime mortgages at a rate higher than a conventional mortgage in order to compensate themselves for carrying more risk. They may also require a shorter repayment term or a cosigner for borrowers with a low credit score. Conversely, a credit score of 700 or above is generally considered good and may result in a borrower receiving a lower interest rate, which results in their paying less money in interest over the life of the loan. Scores greater than 800 are considered excellent. While every creditor defines its own ranges for credit scores, the average FICO score range is often used. Your credit score is one number that can cost or save you a lot of money in your lifetime. An excellent score can land you lower interest rates, meaning you will pay less for any line of credit you take out. But it's up to you, the borrower, to make sure your credit remains strong so you can have access to more opportunities to borrow if you need to. Different countries have different agencies who calculate credit scores. The agencies who arrive at these scores are called credit bureaus. In the United States, the three major credit bureaus are TransUnion, Experian, and Equifax. Credit bureaus collect credit information about people from banks and credit card issuers. They then calculate credit scores using complex mathematical formulas and then sell that information in the form of a credit report to banks and other institutions, including car companies, employers, retailers, etc. So how can you improve your score? First, pay your bills on time. 6 months of on-time payments is required to see a noticeable difference in your score. Second, call your bank and increase your credit limit. It is important to try and increase your credit limit so that you can maintain a lower credit utilization rate. Lower credit utilization leads to increased scores. Third, do not close a credit card account. If you are not using a certain credit card, it is best to stop using it instead of closing the account. Depending on the age and credit limit of a card, it can hurt your credit score if you close the account. This is because your credit utilization goes up when you close a credit card down. And fourth, if you have a poor credit score, work with one of the best credit repair companies. If you don't have the time to improve your credit score, credit repair companies will negotiate with your creditors and the 3 credit agencies on your behalf in exchange for a monthly fee. Now, let's watch a short video courtesy of Investopedia.
Planning to borrow money anytime soon or down the road? You'll need to know what a credit score is. In short, it offers a snapshot of your personal debt repayment history at a single point in time, letting potential lenders know what type of risk they would be taking by loaning you money. Since there are 3 credit bureaus, Experian, TransUnion, and Equifax, you have 3 potentially different credit scores. The numerical value of the scores, also known as FICO scores, ranges from 300 to 850. In general, the higher the score, the lower the risk. A lower score doesn't necessarily mean you can't get a loan, but you will probably have to pay a higher interest rate or be approved for a lesser amount than someone with a high score. So what factors can affect your credit score? You may be surprised. Your payment history is certainly important, as is the length of your credit history, any new accounts that have been opened, the number of recent credit checks, and how many accounts you have in use. Yes, this does include all of those department store credit cards offering deals seemingly too good to pass up. Bottom line, any recent activity on your credit file will affect your score. So what's a responsible consumer to do? Paying your bills on time and not overextending are the best places to start. So when you do need that big loan, your credit score will help you instead of standing in your way.
So, what are our key takeaways from this session? First, your credit score can save or cost you a lot of money over your lifetime. Pay attention to it and take necessary steps to improve your credit score. Second, an excellent credit score will get you a lower interest rate, meaning you will pay less for any line of credit or loan you may take out. Try and increase your credit score when you can, else it will be too late. Thank you for your time. Until next time then, stay enriched and strong.